Hey everyone, Imran here, and let me ask you something kind of crazy. Have you ever looked at your cash, your bank balance, and thought, wait, where does this money actually come from? I mean, seriously, who creates it? Is someone printing it in a basement? Is it the government, the banks, some secret global committee? Well, what if I told you that most of the money you use every single day does not come from the government at all? And what if I told you that the money sitting in your bank account isn't even physically real? Boom, mind blown, right? Today, we're breaking it all down. The real engine behind modern money, how banks actually create it, and why our entire financial system runs on trust, not paper. Let's go. All right, so before we jump into the crazy stuff, we need to start with the basics. Because money today, the money in 2025, is completely different from what your parents or grandparents used. Today, we live in something called a fiat money system. And fiat basically means money has value because the government says so, and because we all agree it does. No gold backing, no silver, no physical limit, just trust. And once you understand this, you'll understand exactly why debt keeps growing, why inflation hits you harder than billionaires, and why the number in your bank account is, well, almost imaginary. Who actually creates money? So let's clear this up right away. People think money comes from two places. One, the government. They think the government prints money physically. Two, the central bank, like the US Federal Reserve. And yeah, these guys do create some money. But here's the real shocker. Over 90% of all money in modern economies comes from commercial banks. Wait, what? Banks? Yep, the same banks you use for checking accounts, savings accounts, loans, all of that. Banks create money out of thin air. Literally. Let me explain. All right, imagine you walk into a bank. You say, hey, I need a $10,000 loan. Now, most people believe the bank goes into a big vault, grabs someone else's savings, and gives them to you. Nope, here's what actually happens. The bank simply types $10,000 into your account. That's it. They don't take money from anyone else. They don't move funds around. They literally create a new deposit that didn't exist 5 seconds ago. Boom, new money just entered the economy. And this is not a conspiracy theory. This is not alternative economics. This is exactly what central banks like the Federal Reserve and the Bank of England have explained publicly. Loans create deposits. Deposits become money.
But what about printing cash? Okay, I know what you're thinking. Imran, come on, what about the physical notes, the actual cash? Good question. Physical money, the notes and coins, usually makes up only around 3 to 5% of total money. That's it. The rest? Just numbers in a computer. Digital money, bank money, credit money. And this is exactly why central banks care more about interest rates than printing presses. Because printing cash is nothing compared to the digital tsunami of loans created every single day.
So, does money come from debt? Yes. In modern economies, money and debt are the same thing. When banks create money, they create two things at the same time. A credit, your new deposit, and a debt, your loan. One cannot exist without the other. So every dollar, every rupee, every pound in the system is someone else's debt. If all loans were paid back today, almost all money would disappear. Crazy, right? This is why countries can never have zero debt. It's mathematically impossible under the system we use. Now you might ask, well, if commercial banks create money, then what does the central bank do? Central banks basically control the rules of the game. They can change interest rates, control how much banks can lend, print physical cash, create digital reserves, bail out banks when things go wrong, buy government bonds. But here's the important thing. The central bank does not control every dollar in the system. It just controls the system that controls the dollars. Think of them as the referee, not the players. You might have heard this before. Banks keep only a fraction of your money and lend the rest. This used to be how things worked.
But in many countries now, including the US, reserve requirements are actually zero. Yep, banks are not required to keep any minimum cash against deposits. Money creation today depends more on bank risk appetite, customer loan demand, interest rates, central bank regulations, not on reserve percentages.
So, where does new money come from in 2025? Let's break it down in a super simple flow. Step 1, you borrow money. Boom, new money is created. Step 2, you spend it. Businesses receive it. They deposit it. It becomes part of the banking system. Step 3, banks lend it again. More money enters the system. Step 4, governments borrow. When governments issue bonds, new money circulates. Step 5, central bank policies push even more money. Lower interest rates means more loans, equals more money. Higher rates means less lending, equals less money. This is the heartbeat of modern economies.
Why inflation happens, the real reason. You know how people love blaming governments for inflation? They printed too much money. But here's the truth. The biggest source of inflation is private bank lending. When banks lend aggressively, especially for real estate, cars, credit cards, business loans, prices naturally go up. And if the supply of goods doesn't increase at the same speed, boom, inflation. It's not always, quote, government printing. It's the entire banking system expanding money faster than goods.
The question is, why the system works, even if it sounds crazy. I know it sounds wild. Money created out of thin air, get equals money, banks typing numbers into accounts. But this system works because of trust and stability. We all trust that banks won't collapse, governments will back deposits, central banks will control crises, markets will accept currency. As long as this trust exists, the system functions smoothly. The danger comes when trust breaks, like in 2008.
Now let's move to 2025. Central banks are exploring CBDCs, central bank digital currencies. Why? Because they want more control, more stability, faster transactions, less reliance on commercial banks, better tracking of money. CBDCs could change everything. Money could come directly from the central bank, inflation could be controlled more precisely, financial crises could be easier to manage. But hey, it also raises privacy questions, and it changes the balance of power in the financial system. This next decade, massive changes are coming. So what does this mean for you? All right, Imran, cool explanation, but what does all this mean for normal people? Here's what matters. 1, money is a system, not a thing. Understand the system, and you predict the future. 2, debt is not always bad. It's the engine of the economy. Smart debt can make you rich. Bad debt makes you broke. 3, inflation punishes savers and rewards investors. This is why wealthy people stay invested, and why keeping your cash in the bank loses value. 4, financial literacy is now a survival skill. The people who understand money control money. All right, if you want more content on finance, AI, economics, and how to build wealth the smart way, you know what to do. Thanks for watching.